Hey guys, if you're new here, welcome to the channel. If you're not, welcome back to another video. This time we're talking about Teladoc. It's a company that I have a small position in. I thought it sounded interesting. Thought it was an interesting concept for an idea. So I put in a bit of money, I guess, depending on your standards, maybe very small, maybe a decent sized position. It's about $5,000 American was my investment in Teladoc. As usual, I won't hide anything, even when it's painful, even when my investment doesn't perform well. So you'll see all the details later on. First off, I just want you to know I'm here sharing your pain. You know, it's been really rough the past few months. To any Teladoc investors out there, you know, could be potentially down 70% depending on when you bought it. I'm right here with you. So if that makes you feel any better at all, let me know down in the comments if you have any losses on Teladoc, how much those losses are in dollars and percentage, what you're planning to do with it, and how you're feeling about the company. That being said, let's go into some details about why Teladoc has absolutely crashed 40% today. A huge drop, really. The company almost lost half of its value in one day. And by the way, that value is already down massively from where it was just a year ago. It's been an extremely painful run. When I bought it, I actually thought I was buying the dip. I thought it was cheap because it had dropped so much. Surely it couldn't drop much more, right? And now here we are. I'm down like way more, something like I'm probably down like 80. No, yeah. Anyway, I'm down a lot. We'll go into the numbers. I'll show you the details. Let's hop into some of the information that came out today about what's causing the stock to move. Okay, guys, so here's a few clippings from today just to show you. At the close, we're now down $40. Sorry, 40%, which is extremely painful. 33.5 dollars per share. I still remember the high-flying days when the share price was huge compared to this. And we're even down more in after hours, which is nice. As if that wasn't enough for you. This is my position here, just to show you, to be completely transparent. So I have 33 shares, cost base is $5,000, and my market value is now $1,100. So absolutely destroyed here. As I said, you're feeling the pain. I'm right there with you, for whatever that's worth. If it makes you feel any better. I know sometimes hearing from other people holding these stocks makes me feel better when I'm stuck with them, with a loss. So my average price is 151, and as we can see, the stock's at 33 and change. 40% of that being down today. And we can't even blame it on the macro markets this time. Usually when you have these drops, you can say, okay, well, yeah, but the markets are selling off lately. Growth stocks are getting punished. High PE stocks are getting punished. Can't say that today. We have green across the board here. We have Dow's up 600 points. NASDAQ is up 3%, which is a massive day for the NASDAQ. That's got to be something like a top, say, 93 percentile day in the markets for the NASDAQ. You don't get 3% moves that often. And to the positive, shows a lot of strength, whereas Teladoc is being absolutely destroyed. So if anything, it should have been dragged up by the macro market moves, not down, and clearly it wasn't. So we can't shift any of the blame here. This is all on Teladoc and what's happening with the company. So let's look at it. So on the face of it, it may not look that bad to you. We see in the press release that the company revised its 2022 guidance down and now expects full year revenue between $2.4 to $2.5 billion. At the end of 2021, Teladoc projected full year revenue between $2.55 and $2.65 billion. So we're down about 100 million in terms of revenue guidance for full year 2022. So I mean, 100 million, 100, and it's not that huge. So you might look at this on face value and say to yourself, surely this doesn't justify a 40% move downward. Like, there's got to be something more to the story. And of course there is. So let's dig a little bit deeper here. So Teladoc's first quarter revenue actually grew 25% to $565.4 million from $453.7 million in the first quarter of 2021. Often when you see a horrible move in a stock like this, you kind of imagine that their revenue shrunk year over year. That's not the case here. Year over year, comparing apples to apples, this Q1 of last year, we still gained revenue. However, we did miss analyst projections of $571.5 million for the first quarter. The company's access fees revenue grew 29% to $491.3 million, and visit fee internal revenue grew 12% to $67.9 million. So, I mean, still growth here, right? We're not shrinking by any means in terms of these numbers anyway. U.S. revenues grew 24% to $491.2 million, and international revenues grew 27% to $74.2 million. Adjusted EBITDA during the quarter decreased 4% to $54.5 million compared to $56.6 million in the first quarter of 2021. So I have to say, guys, these numbers are concerning to me in particular. So our revenue grew, and our EBITDA, which is earnings before interest, depreciation, and amortization, dropped. So we're making more money on the top line, but we're keeping less of it, which means expenses are rising, margins are shrinking, we have more costs. Usually as a company scales, in a growth company like this, you expect as they grow, margins to get better and better. You look at, I know I talk about Tesla a lot, but let's look at them for an example. When they're ramping up their car manufacturing business, margins are horrible. They're losing money. But as they are able to make more and more cars out of that same factory blueprint and gain better margins, though that EBITDA number goes up, the margin number goes up. So things start to look better and better the bigger they scale. And that's just not happening here this quarter, at least, because we're scaling bigger. We can see 25% year over year. And our EBITDA during the quarter decreased. So bad news on that front. I'm definitely a little bit concerned about that. I can't lie. Now let's talk about Levongo. If you're not too familiar with it, Levongo is, was a separate company dealing with smart devices, managing chronic long-term health conditions, something, you can't get cured. You can only manage it and live your life around it. So they have these smart devices, expert support, and health management strategies. And just a picture here of some of their devices available, helping out with various medical conditions you might have that are of a chronic long-term nature, really trying to digitize and make managing these conditions easier for the long term. So it was a big growing company. It was a good business. And Teladoc actually went ahead and acquired it. At the time, it was considered to be a pretty exciting acquisition, to be honest with you. Levongo was a big company. They're very exciting. It's a growing space, a growing industry. Seems to make a lot of sense in terms of fitting in with the overall mission of Teladoc. Obviously, virtual doctor visits, virtual medicine, things of that nature, not having to physically go into a doctor's office. Fit right in with this digital health monitoring and support equipment from Levongo. So it really seemed like a good acquisition at the time. A lot of people were excited about it, but let's see what's going on with this now. So telehealth giant Teladoc said Wednesday, that's a bit of a tongue twister for you, it will take a charge of $6.6 billion to write down the value of its Levongo acquisition. The impairment charge pushed the company to a record loss of $6.7 billion, or a loss of $41.58 per share in the first quarter of 2022, compared to $199.6 million, or a loss of 1.31 per share in the first quarter of 2021, according to its first quarter 2022 earnings press release. The company recorded a non-cash goodwill impairment charge, which does not impact the company's cash or liquidity. So that's a bit of a silver lining here, is this charge doesn't actually impact, how much cash or liquidity the company has. They're just saying this asset they've purchased, Levongo, is now worth much less than it used to be, and they have to reflect that. So companies opt for impairment of these when the value of assets or goodwill on their books is no longer fully recoverable. So yeah, if they had just decided to sell off Levongo again, they're not going to get back what they paid for it, basically. So how bad is this really? Well, just to give you a bit more background information on what these impairment charges are, it's basically an accounting term used to describe a drastic reduction or loss in the recoverable value of an asset. It can occur because of a change in legal or economic circumstances, or as the result of a casualty loss from unforeseen hazards. Impairment charges may be booked as goodwill for the acquiring company in the acquisition. So that's what is happening with Teladoc in this case. How bad is it though? Well, it's pretty bad when you look at it. It's unbelievable, actually. I'm not gonna lie. So back when Teladoc purchased Levongo, the deal was valued at $18.5 billion. So not cheap by any means, of course. Now, Levongo is a part of Teladoc at this point, and what's the value of Teladoc today? Well, they have 161.14 million shares outstanding. So if you multiply that by the share price, which is currently 33.5, actually a bit lower in after hours, so we're even worse here. But at this point, what's the difference really? What's a few $1 billion here or there? That means the combined value of the total company is $5.4 billion. So imagine that. Teladoc purchases Levongo in a deal valued $18.5 billion. And not that long later, here we're sitting now, the combined two companies together are only worth $5 and under $500 million. So just Levongo, that's like, more than a 3 times drop. Like, if we were just talking about the value of Levongo here, dropping from 18.5 to 5, like that would be bad enough. But it's not just that. It's the entire overall company, including the part that existed before the acquisition. It's just absolute, it's very rare you'll see anything like this, just to be completely honest with you, a collapse of this magnitude. Now, of course, after this quarter, a lot of analysts have been revising their forecasts, revising their positions. 6 analysts have now downgraded the stock on these results. Not unsurprising, given what's been going on. So where does that leave us today? Well, just going to be honest with you guys, it's definitely been a painful one to hold. And I just kind of bought this because it seemed like a kind of a fun story. It was kind of a speculative gamble on my part. I have to say I didn't research it to the depth that I would one of my major holdings. It just was kind of like a fun, let's see what happens on this one type move. So from that sense, at least I'm not too devastated by it. It's not one of my biggest holdings. If Teladoc is your biggest holding out there, you have my sympathy. I know how it feels to have something like this just completely get destroyed. It's really rough out there. But, the story isn't over. So, yes, the Levongo write-down doesn't look good, but we're still growing our revenues. The company isn't completely dead. So I'm not going to sell this one just yet. I'm just going to hold on to it and see what happens. As I said, it's not one of my core holdings. It's not one I have researched as thoroughly as some of these other companies. So I'm not prepared to average down and buy more, but I really wish, like if this is a stock I've been researching closely for years and I had the conviction, then I might consider averaging down. But unfortunately, it's just not one of my core companies that I look at. So it reminds me a little bit of Tesla back in 2018. They had a big crash really before they ran up huge. I don't know if a lot of you guys remember this if you were in on Tesla back then, but some people thought it was going to go out of business because of the Model 3 ramp problems. So it was struggling, and the stock absolutely crashed. And at that point, because I followed Tesla so closely and I did have that high conviction, I averaged down. And honestly, that was the best investment I've ever made in my life. The return on it has been unbelievable. Talking like 20 plus times, which doesn't happen that often. But if you have that conviction, you have the knowledge on the company, I could see why you might want to do that. If you do know more about the company, let me know down in the comments. Definitely interested to hear the perspectives of other people. What you're doing, are you averaging down? Do you still believe in the story? Do you still believe in the company? I mean, I have to say, I'd personally much prefer, pulling up a video call on my phone, talking to my doctor, and then getting my prescription instead of having to go all the way into the doctor's office, sitting in the same small room as all these other sick people who might get me sick. And then I've got to sit in that waiting room for ages with nothing but all those little magazines there to try and keep myself entertained. And then after I finally get into the new, smaller waiting room, you think you're going to see the doctor, but no, you're going to wait some more. So if you can, do your waiting from the comfort of your home, do other things while you're waiting for the doctor to come onto the app, it seems like such a better experience. So I'm going to continue holding it and see what the future holds for Teladoc. But as I said, it's definitely not like a make or break my portfolio type stock. Just kind of a fun, let's see what happens on this speculative play. Clearly it hasn't worked out so far. If you've enjoyed this video, please do consider hitting like and subscribe, and I'll talk to you guys again next time. Thanks. Bye.